Hello and welcome back to FX Limit, where we dive deep into the world of Forex trading and explore powerful tools to enhance your trading skills. Today, we're going to unravel the secrets of the Money Flow Index, or MFI, a fascinating tool that can significantly improve your trading decisions by assessing buying and selling pressure in the market. So, what exactly is the Money Flow Index? The MFI is a momentum indicator that combines price and volume data to identify potential reversals in the market. It's often referred to as the Volume-Weighted Relative Strength Index because it incorporates both price and volume, unlike the standard RSI which only considers price. The MFI oscillates between 0 and 100, and by interpreting its value, traders can gain insights into the market's sentiment and potential price movements. Let's talk about how to calculate the MFI. The process involves several steps. First, we calculate the typical price for each period, which is the average of the high, low, and closing prices. Next, we multiply this typical price by the volume for that period to find the money flow. Then, we sum up the positive and negative money flows over a specified period, usually 14 days. The money flow ratio is then calculated by dividing the sum of positive money flow by the sum of negative money flow. Finally, we use this ratio to calculate the MFI. Now, how do you interpret the MFI? Generally, an MFI above 80 suggests that the market is overbought, while an MFI below 20 indicates that the market is oversold. These levels can signal potential trend reversals. For instance, if the MFI is above 80 and starts to decline, it might be a sign that the buying pressure is decreasing and a downtrend could be imminent. Conversely, if the MFI is below 20 and begins to rise, it could indicate increasing buying pressure, suggesting a potential uptrend. But there's more to the MFI than just overbought and oversold signals. Divergences between the MFI and price action are crucial. A bullish divergence occurs when the price makes a new low, but the MFI does not. This can be a sign that the selling pressure is waning, and a trend reversal to the upside might be on the horizon. Similarly, a bearish divergence happens when the price hits a new high, but the MFI doesn't, indicating that the buying pressure might be weakening and a downward trend could be starting. Another interesting aspect of the MFI is its use in identifying fakeouts. Sometimes, the market might seem to be breaking out, but the MFI can help you determine whether the breakout is backed by strong money flow or if it's just a false signal. If the breakout is not supported by a corresponding move in the MFI, it might be a fakeout. It's important to remember that no indicator is foolproof. The MFI is a powerful tool, but it should be used in conjunction with other indicators and analysis techniques. For example, combining the MFI with trend lines, support and resistance levels, or other momentum indicators like the MACD can provide a more comprehensive view of the market. In conclusion, the Money Flow Index is a versatile and valuable tool in Forex trading. It helps traders assess buying and selling pressure, identify potential trend reversals, and avoid false breakouts. By understanding and correctly interpreting the MFI, you can make more informed trading decisions and potentially improve your trading performance. That wraps up our exploration of the Money Flow Index. If you found this information helpful, don't forget to like, share, and subscribe to FX Limit for more insightful trading tips and strategies. Stay tuned for our next video where we'll dive into another fascinating aspect of Forex trading. Happy trading, and see you next time.